Hello everyone, my name is Jeffrey Kennedy and welcome back to another episode of Market Academy. Well, as you know, this week we're kind of doing a basic review of the ZigZag, one of the three types of corrective Elliott wave patterns, and that would be this structure right here. And remember, going back to yesterday, the subdivisions or the notation an Elliottian might use to identify a zigzag would be 535, and that just simply means that wave A subdivides into 5 waves. Wave B, of course, is a 3-wave move, and then wave C unfolds as a 5-wave structure. Now remember, wave C can unfold as either an impulse wave, 1, 2, 3, 4, 5, or as an ending diagonal. Okay, so what again I think is very, very important is being able to, number one, recognize and identify the line diagrams, but it does take a little bit of practice to move your eyes, your vision, to be able to identify these patterns on an open, high, low, close price chart. So what I like to do whenever I do my instruction, whenever I do my teaching, is to also offer examples of each one of these patterns so you kind of get an idea what it actually looks like on a price chart. Okay, so we're going to look at a few examples of of zigzags in various markets, various time frames, well, primarily daily and weekly. But I just want to kind of show you again, kind of going back to what we discussed yesterday, where you'll see much of what we discussed actually illustrated on the price chart. So this is just a simple example. Now, before I get too deep in just showing you the examples, I do want to stress something very, very important. And I talked about this in my book, The Visual Guide to Elliott Wave Trading. Whenever you're looking at a price chart, you might not see a wave pattern you recognize. Okay, so for example, if you're looking for examples of zigzags, you might look at a price chart and go, well, I don't see a zigzag. Okay, well, if that's the case, move on. Okay, just move on to another market, move on to another price chart. One thing I do not like to do, I find that it's actually a big mistake to do, is to stare at a price chart for 10, 15, 20 minutes or hours on end and, come up with something that might work. Okay, that's usually a really bad mistake to do, because what happens whenever you look at a price chart and you study it trying to see what's going on, a lot of times you'll default to whatever subconscious bias you may have, and you begin to see exactly what you want to see. So in other words, the kind of rule of thumb I talk about again in my book, but also too I like to recommend anytime I'm talking about the wave principle is like, look, simply put, if you can't count it, don't trade it. It's that simple. If you're looking at a market, looking at a price chart, and wave patterns look like all junky and confusing, move on. Okay, if you can't count it, don't trade it. Okay, so going back to examples of zigzags. Okay, now in this example here, again, the big thing that I want you to observe, this is clearly a 3-wave move off the high here in October of 2024, down, 3-wave move up for wave B, and then you come down in wave C. Now, in this example here, you didn't quite see the equality type multiple that we look for between wave C and wave A, because equality was all the way down here at 3014. But notice that third Fibonacci relationship. Remember, we were looking at Fibonacci relationships and specifically how they pertain to zigzags. Remember, the most common Fibonacci retracement for wave B is 382, followed by 618, followed by 50%. The most common multiples between wave C and wave A would be number 1, equality, number 2, 1.618, number 3, 0.618. Well, as you can see, that comes into play right here. That's your 618 multiple between wave C and wave A. Also, too, remember when I showed you the example of the Kennedy channeling technique having to do with corrective price channels, specifically pertaining to the zigzag, and I described something that I refer to as a bottom line reversal and then a center line reversal? Well, here is your center line reversal utilizing the KCT technique. Okay, so again, just a 3-wave move contained within parallel lines. This is a counter trend move. And just simply knowing that little piece of information is critically important to being able to identify a high confidence trade setup. Why? Because counter trend moves, corrective patterns and counter trend moves are the same thing. If you see a correction such as this, that basically tells you that this is a counter trend move in the direction of the larger uptrend. Thus, you have a buy-side oriented type position working here. So again, this is why I love to, as far as my trading style, I like to identify a trending market, buy pullbacks and uptrends, sell bounces and downtrends. But the kind of pullbacks and the kind of bounces my eyes always gravitate to and toward are going to be three-wave structures, choppy, sloppy price action, and again, always contained within parallel lines. Next, let's move on and take a look at another example. And again, what do you see here? Okay, from the low that occurred back in what was that, early August of 2024, up, down, and up. Three waves, okay, A, B, C. The move is contained within parallel lines, and this is an example of a basically, instead of a bottom line reversal, because this is a counter trend move in a bear market, what you see is you see a top line reversal, okay? Again, very simple to identify. So one thing that if you're looking for high confident trade setups, simply go around, look at a bunch of price charts, and this is the picture you're looking for. This is the picture that equates to a high confident trade setup. Same thing over here. Again, three waves up, counter trend move, parallel lines, attempt to close the price gap. We've done lessons on price gaps. Boom, nice reversal to the downside. And then, of course, at some point I will be doing some lessons on my reverse Fibonacci technique. This gives me some objectives to the downside, and as you can see, came very, very close to that 2.0 multiple. And I'll show you again that technique in an upcoming or later video. Okay, let's move on. Let's take a look at another one. This is KLA, KLA Corporation, ticker symbol KLAC. That's why I call it KLA. Okay, what do you see here? Going back to pretty much the entirety of the price action which occurred in 2022. You have a down move, a bunch of ugly stuff here, up, down, up, and then you coming down again. Again, key takeaway, the move, the sell-off that began in early January 2022 was contained within parallel lines. That is a counter trend move. That means the larger uptrend is still intact. You have higher to go. Okay. Now, as far as the B wave in this instance, that is actually an expanded flat. It's a variation of a flat corrective structure, and we'll be talking about that in more detail next week. Let's look at another example, okay? And again, on the weekly time frame. Now here we have, again, going back to actually 2018, big move down, impulsive decline, and then you essentially go sideways for more than a year. But that actually, too, equates to a counter trend move. How do I know that? Okay, well, let's put on our parallel lines here. Okay, so what we're simply doing is we're basically identifying the price action which occurred in late 2018. Notice the movement to the upside, what I'm identifying as purple B in a circle. Okay, notice how that entire move was also, too, contained within parallel lines. So you have a counter trend move, a very lengthy wave B, again, within the larger zigzag decline, A, B, C. Counter trend price action tends to be contained by parallel lines, and it tends to basically subdivide into, simply put, three wave structures. Very, very simple. Okay, and this is kind of a neat example because this kind of leads to kind of picks up on last week's lesson. Remember, we were talking about ending diagonals. Okay, well, here is a zigzag ABC where wave C was an ending diagonal, and remember how an ending diagonal is supposed to terminate? Very swift and very sharp back to below the origin of the pattern. Well, exactly how that price action did indeed resolve in 2018. And again, what do we have here? 535 contained within parallel lines. Okay, very, very simple. These Elliott wave patterns that we talk about, and you know I talk about this page all the time, and I say that this is the money shot. Okay, this slide right here is your foundation, your Elliott wave foundation. These are the principal patterns that we work with as Elliottians. Everything starts here. So if you're looking to become an expert Elliottician, you need to master this initially, and then you can begin to, say, evolve and move into the realms of, say, the variations and complexities, because again, just simply going back and taking a look at some examples of what we've done here, Three-wave move contained within parallel lines. This is not difficult to identify. And moreover, this is a counter trend move in a larger downtrending market. So if you're looking for high confident trade setups, and again, what we're doing today, I'll see if I can't find some good intraday examples, like look for these types of structures on, say, shorter term time frames, 60-minute, 15-minute. I'll see if I can't do that tomorrow. But again, the same idea holds true. Doesn't matter if you're looking at an intraday price chart, daily price chart, weekly price chart. If you're looking for a high confident trade setup, this is it. Simply put, a three-wave move contained within parallel lines, okay? Does it always work? No. But when I find out that it doesn't work, more often than not, two or three things are going on which speaks to why the structure, why the original identification did not work out. Number one, did not follow the rules and guidelines of the wave principle. Number two, had some kind of bias, okay? You were just thinking that, hey, this has to go up, okay? I don't care what everybody's saying, but I think it's going to go up. So you begin to force fit whatever interpretation you want on a price chart. Don't do that. You have to be what I refer to as intellectually honest, okay? If you're going to utilize technical analysis, the best benefit, the most accurate, say, application of technical analysis, if you're looking to be really, really good, then bottom line, you simply look at the data and you walk away with a result. You don't utilize or manipulate technical analysis to a predetermined end. Well, that's about it for me for today, and tomorrow we'll pick it up again. Zigzags, that's the lesson for the week. And again, what I'll try to do tomorrow is give you some examples on shorter term time frames. 15-minute, 60-minute, 120-minute, for those of you who might be a little bit more short-term oriented in your trading. Well, as always, thank you very, very much. I will see you tomorrow.